Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cleveland-Cliffs Inc. Annual Report. Cleveland-Cliffs Inc. offers a diverse range of products and services across various industries. The company's primary business involves the production of steel products, including hot-rolled, cold-rolled, and coated products such as aluminized, electro-galvanized, and galvalume products. In addition to steelmaking, Cleveland-Cliffs also provides non-steel making products like stamped components, tool and die, and tubing. The company is involved in the mining of iron ore and production of pellets and direct reduced iron. Furthermore, it processes ferrous scrap through primary steelmaking and downstream finishing. The company's services extend to various sectors, including direct automotive, infrastructure and manufacturing, distributors and converters, and steel producers. Cleveland-Cliffs also offers tubular components, including carbon steel, stainless steel, and electric resistance welded tubing products. Overall, the company provides a wide range of businesses and services, including steel production, hot-rolled, cold-rolled, coated and plate products, non-steel making products, stamped components, tool and die, and tubing, iron ore mining and processing, pellet and direct, reduced iron production, ferrous scrap processing, tubular components, carbon steel, stainless steel, and electric resistance welded tubing products. The recent surge in Cleveland-Cliffs Inc.'s stock price can be attributed to several key news events and broader market trends. One significant factor was the company's positive Q3 2025 earnings, which exceeded analyst estimates due to better price realization and a favorable product mix. This was followed by a memorandum of understanding with POSCO, a major global steel producer, which is expected to be highly accretive to shareholders. Additionally, Cleveland-Cliffs announced a breakthrough in replacing aluminum with steel in automotive stamping equipment, signaling potential new opportunities in the automotive sector. The company's CEO also expressed optimism for 2026, citing improvements in challenges faced in 2025 and a constructive U.S. trade environment. Analyst upgrades and positive sentiment also contributed to investor confidence. Morgan Stanley upgraded Cleveland-Cliffs to overweight with a $17 price target, citing optimism about the steel sector's potential. Institutional investors increased their holdings in the company, indicating a bullish outlook on its prospects. Broader market trends also played a role in the stock price increase. The steel industry generally benefited from a strong outlook in infrastructure, construction, and automotive markets. Anticipation of economic recovery, potential interest rate reductions, and robust government infrastructure investment fueled optimism for steel producers. Supply-side factors like tariffs on imported steel made domestic steel more appealing for projects in the United States, supporting demand and pricing for companies like Cleveland-Cliffs. Overall, these combined factors contributed to the sustained increase in Cleveland-Cliffs' stock price during the past year. Cleveland-Cliffs Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Cleveland-Cliffs Inc. trades at a higher price-to-book ratio of 1.08 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be identified through various financial metrics. In this case, the steelmaking segment experienced a significant increase in revenue, rising by 14% from $18.62 billion to $21.41 billion between 2023 and 2025. This substantial growth is likely due to increased demand for steel products or improved operational efficiency. Another factor contributing to revenue growth is the increase in finance leases within cash flows from operating activities. Between 2023 and 2025, this figure rose by $55 million, from $23 million to $68 million. This indicates that the company's financial performance has improved, allowing it to generate more revenue through leasing activities. The Other Businesses segment also experienced a modest increase in revenue, rising by 1% from $0.66 billion to $0.67 billion between 2023 and 2025. While this growth is not as significant as that of the steelmaking segment, it still suggests that the company's other business operations are performing relatively well. Unfortunately, there is limited information available on the primary drivers of revenue decline. However, by analyzing the factors contributing to revenue growth, we can infer that improved operational efficiency, increased demand for products, and enhanced financial performance are key drivers of revenue expansion. The net income of a company underwent significant changes between 2023 and 2025. In 2023, the company reported a net income of $436 million, but by 2025, this had decreased dramatically to a net loss of -$714 million. This decline in net income can be attributed to several factors. One major reason for the decrease was the accelerated depreciation expense of $131 million in 2025 due to the decision to indefinitely idle Conshohocken and Riverdale facilities. Additionally, there was an increase in amortization expense related to intangible assets from $24 million in 2024 to $81 million in 2025. The profit margins also saw a significant decline during this period. In 2023, the company's profit margin was approximately 2%, but by 2025, it had dropped to a -3%. This decrease in profit margins can be directly linked to the net loss incurred by the company in 2025. The combination of these factors resulted in a substantial decline in both net income and profit margins over this two-year period. The financial health of a company can be gauged by its ability to generate positive operating cash flow. A decrease in cash balance over time is often an indication of negative operating cash flow. In the case of Cleveland-Cliffs Inc., the available information suggests that this may be true. According to the extracted summaries, the company's cash balance decreased from $198 million at the end of 2023 to $57 million at the end of 2025. This significant decline in cash balance over a two-year period is a red flag for investors and analysts. It indicates that the company may not be generating enough operating cash flow to sustain its business operations. While there is no specific mention of operating cash flow in some sections, the overall trend suggests that Cleveland-Cliffs Inc. may be struggling with negative operating cash flow. This can have serious implications for the company's long-term sustainability and growth prospects. The company's debt level has experienced a slight increase over the past year. According to the financial data, the total long-term debt rose from $7,065 million in 2024 to $7,253 million in 2025, representing an increase of $188 million. This indicates that the company has taken on more debt in recent times. However, due to the lack of comparable interest expense data for previous years, it is challenging to determine if there have been any significant changes in this area. The only available information shows a net interest expense of -$370 million in 2025, but no corresponding figures are provided for 2024 and 2023. As such, we cannot accurately assess whether the company's interest expenses have increased or decreased over time. The financial performance of Cleveland-Cliffs Inc. varied across different segments and regions in 2025. The steelmaking segment stood out as the largest and most profitable segment, accounting for approximately 98% of total revenues. It has a significant presence in various markets, including automotive, infrastructure, and manufacturing. On the other hand, the Other Businesses segment struggled, with an adjusted EBITDA loss of $16 million. This segment's capital additions were limited to only $10 million. The Tubular and European Operations segments did not receive specific mentions regarding their performance, but it is worth noting that detailed information about these segments was lacking in the report. The steelmaking segment also experienced mixed results, with a 12% decrease in revenue compared to the previous year. Additionally, net cash used by operating activities was $462 million. Overall, while some segments and regions performed well, others struggled, highlighting the need for further analysis of Cleveland-Cliffs Inc.'s financial performance. Management's outlook and strategy: the company is facing significant challenges in 2025, including declining revenue and a net loss. Despite this, the steelmaking segment remains a key contributor to revenues and profitability. However, various factors are impacting its financial performance. To address these challenges, management has updated closure costs estimates and timing of expected cash flows for certain mines. They have also acknowledged exposure to price risk associated with fluctuations in market prices of purchased raw materials and energy sources. Management is focused on improving the company's financial performance and governance structure. The company reported net sales of $7.4 billion for the year ended December 31, 2025, and net income was $1.3 billion. Overall, management is working to address key challenges while maintaining a strong focus on financial improvement. The company's financial activities have been focused on share buybacks in recent times. One notable instance is the purchase of 588,000 shares of its common stock between October 1 and 31, 2025. This move indicates that the company has chosen to invest in itself by reducing the number of outstanding shares rather than distributing profits through dividends. That concludes the financial summary for Cleveland-Cliffs Inc. Feel free to comment below, and I will be happy to answer them when possible.